Ladies and gentlemen, welcome back. It's January 2nd, 2026, and I need to show you something that happened while most people were celebrating New Year's Eve. At 11:47 p.m. on December 31st, the Chinese government made a move that just fractured the global silver supply chain in a way that cannot be undone. And the price you're seeing on your screen right now is not telling you the real story. I'm a commodities analyst who's been trading and stacking physical silver for 12 years, and I built this channel because I got tired of watching AI-generated garbage flood YouTube with fake news about silver, while the real story was sitting right there in the data. I have access to Bloomberg terminals and vault reports that most retail investors never see, and I'm using this AI avatar for one reason only: speed. Because by the time the mainstream media figures out what's happening, the opportunity to act will already be gone. Here's what they're not telling you. The spot price is trading at $72.79 as of a few hours ago. That's the number you'll see on every financial website, every brokerage app, every news ticker. But that number is fiction. The real price, the price where actual metal changes hands in the physical world, is somewhere north of $80. And I'm going to walk you through exactly why that gap exists, what it means for the next 30 days, and what I'm personally doing about it. Let me start with the facts. On January 1st, 2026, China's Ministry of Commerce officially implemented a new export licensing system for silver. This isn't a tariff increase or a temporary restriction. It's a full lockdown. Only 44 state-certified firms are permitted to export silver from China now, and from what I'm seeing in the shipping data and the vault flows, none of those firms are moving significant volume. China has reclassified silver as a strategic resource, putting it in the same category as rare earth elements and antimony. This is confirmed policy from their Ministry of Commerce, verified by CNBC and Trading Economics. This is not speculation. Now, the narrative you are going to hear from mainstream outlets today is that commodities had a quiet start to the year. Silver up 0.13%, nothing dramatic, business as usual. But that surface level reading misses the entire story. Because underneath that calm spot price, the physical market is in absolute chaos. I pulled up APMEX's inventory this afternoon. Standard 100-ounce silver bars are listed at $8,101. Let me break that down for you. That works out to $81.01 per ounce. The spot price is $72.75. So we're looking at an $8 to $9 premium, which translates to over 12% above the official spot price. And here's the thing that should terrify anyone short this market. Most of that inventory isn't even in stock. It's marked pre-sale or delayed delivery, which in dealer language means they're taking your order and hoping they can source the metal later. This isn't isolated to one retailer. I'm seeing similar premiums across SD Bullion, JM Bullion, every major dealer in North America. The physical market is trading at a completely different price than the paper market. And there are unconfirmed reports coming out of Japan that physical silver is changing hands at $130 an ounce in some retail channels. I can't verify that number, but I can verify the 12% premium here in the US is absolutely real. So we have an official price of 72 and a physical price of 81. That $9 spread is not normal, and it's not sustainable. Now let me show you the supply side of this equation, because this is where things get really interesting. COMEX registered inventories, that's the physical metal available for immediate delivery, have collapsed by roughly 70% since their 2020 peak. I was looking at the CME Group data this morning, and we're sitting at decade low levels right now. The math is brutal. There are approximately 300 ounces of paper silver in the form of futures contracts and derivatives for every one physical ounce sitting in a registered COMEX vault. Under normal market conditions, that ratio doesn't matter because most futures traders never intend to take delivery. They're speculating on price movements and they settle in cash. But we are no longer operating under normal conditions. And that brings me to the single most important concept you need to understand right now, because it explains everything that's about to happen. I need to talk to you about backwardation. This is not some obscure technical term. This is the market's way of screaming that the system is broken. Let me explain it simply. Backwardation happens when the price for immediate delivery, what we call spot price, is higher than the price for future delivery. In a normal, healthy commodity market, the opposite is true. Future prices trade at a premium to spot because you have to account for storage costs, insurance, financing costs over time. That normal state is called contango. But silver right now is trading in backwardation. The spot price is about 70 cents higher than the nearest futures contract. Let me give you an analogy that makes this crystal clear. Imagine you walk into a car dealership. There's a used car on the lot right now, available today, and the dealer wants $50,000 for it. But sitting in the showroom is a contract for a brand new version of that exact same car. Lower mileage, better condition, and the dealer will deliver it to you in 3 months for only $40,000. Which one do you buy? Obviously, you take the new car and wait 90 days. Unless you have a very specific reason not to wait. Maybe you need to drive across the country tomorrow and can't wait. Or maybe you fundamentally don't trust that the dealer will actually deliver that new car in 3 months. Maybe you think the dealership itself is going to go bankrupt before your delivery date. That's what backwardation signals. It's not about impatience. It's about a complete breakdown in trust. Right now, industrial users of silver are paying a 70-cent premium per ounce to get metal delivered immediately rather than waiting 90 days for a futures contract to mature. We're talking about solar panel manufacturers, electronics companies, EV battery producers. These are sophisticated buyers with entire procurement teams. And they're willing to pay more for immediate delivery because they do not believe the metal will actually be available in 90 days. They don't trust the paper market to deliver physical metal anymore. And when the paper market loses its ability to deliver the one thing it's supposed to deliver, which is the underlying commodity, the paper price becomes meaningless. That's when you get vertical price moves. Because suddenly the only price that matters is the price in the physical market. And there's no mechanism to arbitrage the two back together if there's no physical supply to arbitrage with. Let me show you what this looks like on the chart. We hit a peak in December at $84. That was a genuine blow-off top. You can see the long rejection wicks on the daily candles where sellers stepped in hard. But here's what didn't happen afterward. We didn't see a collapse back down to the $60 range. We didn't see a flush of speculative long positions. Instead, the price found solid support at $71 and has been consolidating there for days. I'm calling that 71 level the physical floor. It's the price point where there's enough buying demand to absorb every bit of paper selling pressure. And the fact that it held through the end of December, through holiday liquidity, through year-end portfolio rebalancing, tells me something critically important. This is not behaving like a speculative bubble. This is behaving like a genuine supply squeeze. And supply squeezes don't resolve with a price correction. They resolve with either new supply coming online or a complete repricing of the asset. China just made sure there's no new supply coming. So we're left with option 2. Now, I want to address the bear case head on because there is a legitimate argument to be made here. The Bloomberg Commodity Index, ticker BCOM, is required to rebalance its positions in early January. Silver gained 175% in 2025, which means it's now massively overweight in the index. BCOM has to sell approximately 9% of its total silver holdings to bring the weighting back in line with their mandate. That's forced selling, and forced selling creates downward pressure on price. The bears are betting this rebalancing will pop the bubble and send silver tumbling back into the 60s or lower. Here's why I think that argument is flawed. Forced selling of paper futures contracts does not create physical metal. If BCOM dumps 9% of its futures position while China has shut down exports, while COMEX vaults are at decade lows, while we're already in 70-cent backwardation, what actually happens? The backwardation explodes. It goes from 70 cents to $1 to $2, maybe even $5. The paper market sells off on the forced liquidation, and the physical market just decouples even further. And here's the other piece of evidence. I was watching the volume on December 31st. We saw elevated selling volume, but the price barely moved. That's classic absorption. Somebody on the other side of those BCOM sales was aggressively buying. And I would bet everything I own that it's not retail traders. It's industrial end users or sovereign entities who understand that the game has fundamentally changed. There's a second bear argument worth addressing. At $80 per ounce, demand destruction should kick in. Solar manufacturers will engineer around silver, use thinner layers, or substitute copper where possible. EV battery makers will find alternatives. And yes, at the margin, that's probably happening. But silver represents a tiny fraction of the total bill of materials for a solar panel or an EV battery. A manufacturer is not going to idle a billion-dollar production facility because silver went from $30 to $80 per ounce. They'll pay $150 before they shut down the line. The bears are banking on an economic theory. The bulls are banking on physical reality. In a supply crisis, physical reality wins every single time. So what happens next? Let me walk through the institutional playbook because I've traded through enough of these situations to know how this plays out. The COMEX is going to hike margin requirements. I'm expecting an increase somewhere between 20 and 50% within the next 7 to 10 days. They'll frame it as prudent risk management, but the real purpose is to force liquidations. Retail traders who are running leveraged long positions get stopped out. The price dips temporarily, and the banks use that dip to cover portions of their short positions at better prices. It's a shakeout mechanism, and it's brutally effective. But here's the flaw in that strategy. Hiking margins doesn't create physical silver. It just clears out the weak hands. And if the physical shortage is genuine, if China's export restrictions are permanent, if COMEX vaults are actually as depleted as the data suggests, then all the margin hikes do is delay the inevitable reckoning. Eventually, someone stands for delivery. And when they do, the exchange has two choices. Deliver the physical metal, which they may not have, or invoke force majeure and settle the contracts in cash at a price they determine. Force majeure is the nuclear option. It's what exchanges do when the system breaks. They literally rewrite the contract terms in the middle of the game. They say, we know you bought a futures contract that legally entitles you to physical delivery of silver, but we're going to give you cash instead. If you don't like it, feel free to sue. I'm not predicting that this will definitely happen, but I am saying you need to be prepared for it, because the alternative is the COMEX publicly admitting it cannot fulfill its delivery obligations. And at that point, the entire futures market loses credibility instantly. Let me show you the math on what a full repricing would look like. Based on the current 70-cent backwardation and the $9 physical premiums we're seeing at retail, the true market clearing price for silver is already around $82. That's what the physical market is discovering in real time beneath the surface of the official spot price. But let's stress test this scenario. There's a rumor that's been circulating, and I need to be extremely clear that this is unverified, that the US government attempted to purchase 50 million ounces of silver directly from Beijing using a structured treasury bond swap to bypass the SWIFT payment system. According to this rumor, China rejected the offer outright. I cannot confirm this happened. Neither the Shanghai Port Authority nor the US Treasury has commented. But if that rumor is true, think about the signal it sends. It would mean the world's largest economy just discovered that its debt instruments are no longer accepted as payment for hard assets. That would be a seismic shift in how global trade operates. Now, let's talk about the banks. The major bullion banks who act as market makers are holding significant net short positions in silver. I don't have their exact exposure because that data isn't public, but I can model it. If silver reprices to a physical clearing level of $110 to $130, which is allegedly where some Asian markets are trading, right now the mark-to-market losses on those short positions would reach into the billions of dollars. We're not talking about a quarterly loss. We're talking about a hit to Tier 1 capital ratios that could trigger solvency concerns. And remember that 300 to 1 leverage ratio I mentioned earlier. 300 ounces of paper claims for every 1 ounce of physical metal in the vaults. If even 10% of the long position holders decide they want physical delivery instead of cash settlement, the system mathematically cannot fulfill those requests. And China just gave every single long position holder in the world a very compelling reason to stand for delivery. Let me summarize where we are right now. China shut down exports effective January 1st. Physical premiums are at historic highs of 12% over spot. The market is in backwardation, which signals a complete loss of faith in the futures delivery system. COMEX inventories are sitting at decade lows, and the official paper price is 72 while the physical price is 81. That $9 gap is the market screaming at you that something is fundamentally broken. You're also going to hear a narrative over the next few weeks that silver is in a bubble, that this is Reddit-fueled retail mania, that it's going to crash just like 2011. I was trading in 2011. I watched silver spike from 30 to 49 and then get cut in half. But 2011 was a momentum trade driven by speculation. This is a supply crisis driven by fundamental shortages. In 2011, there was no export ban from the world's largest producer. There was no 70% drawdown in exchange inventories. There was no backwardation. The structure is completely different. But let me steelman the bear case fairly. Let's say I'm completely wrong. Let's say the BCOM rebalancing triggers a sell-off. Let's say margin hikes force liquidations and the price drops to $60 or even $50. What happens to the physical shortage? Do the premiums vanish? Do solar manufacturers stop buying? Does China reverse its export ban? No, the physical shortage intensifies, and the gap between paper and physical pricing gets even wider. So even if the bears are correct about near-term price action, they're still wrong about the underlying structure. Here's what I'm personally watching. The $71 support level is my primary signal. If silver holds above 71 through the January BCOM rebalancing, that tells me the transition from a paper-controlled market to a physical-driven market is complete. The fact that it held above 70 through the December 31st sell-off is a massive indicator. It means there's a natural bid under this market that cannot be shaken by index flows or institutional selling. The second thing I'm monitoring is the EFP spread. That stands for exchange for physical. It's the premium you pay to convert a paper futures contract into actual physical metal. Right now it's elevated, but not broken. If the EFP spread blows past $1 per ounce, that's your flashing red signal that the COMEX has officially lost control. At that point, price discovery shifts entirely away from the futures market and moves to wherever physical metal actually exists, which increasingly is not in COMEX vaults. Now let me tell you my actual plan, because I don't have a crystal ball, and I'm managing this based on probability and risk. My primary focus is on that 71 support. If silver holds 71 through the BCOM rebalancing over the next week, I'm looking to add to my physical position on any dip. I'm not chasing the price at 72 or 75. I'm waiting for a pullback, potentially to 68 or 69, and using that as an opportunity to increase my stack. The fact that 71 held through year-end chaos suggests the market has established its floor, but I also have a defensive trigger. If the COMEX announces a margin hike above 20% this week, I'm staying completely out of the market. I've watched this playbook run before. They hike margins, trigger forced liquidations in a thin market, hunt stop losses, and create a temporary price crash. I have no interest in trying to catch that falling knife. I'll wait for the panic to exhaust itself, for the blood to be in the streets, and then I'll step in when sentiment is at its worst. Here's my broader philosophy on this. I'm not looking for a trade. I'm looking for insurance against a system where the ask price eventually says unavailable. I've been stacking physical silver for 12 years, and I've lived through plenty of volatility. But I have never seen a structural supply shortage like this. I've never seen a major exporting nation just shut off the tap overnight with no warning. This is genuinely new territory, and I'm not playing by their rules anymore. I'm not using leverage. I'm not trading futures contracts. I'm not buying silver ETFs backed by some vault I can't audit and can't access. I'm buying physical metal and taking personal custody. Because when the paper market breaks, and my read of the data says it's going to break, the only thing that will have value is what you can physically hold. Now, let me be very explicit about something. I'm not telling you to buy silver. I'm not providing financial advice. I'm showing you the data I'm seeing and explaining what I'm personally doing with my own capital. You need to make your own decisions based on your own research and your own risk tolerance. But I will say this. If you're waiting for CNBC to tell you there's a crisis, you'll be too late. By the time mainstream media picks up this story, premiums will be at 20 or 30%, not 12. And the metal will already be gone from retail channels. Let me also address what I expect from the media over the next few weeks. You're going to see a narrative shift. Opinion pieces about how silver is a bubble. Stories about Reddit manipulation. Maybe even some pieces linking silver buying to tax evasion or criminal activity. This isn't accidental. The vaults are empty. The banks are short. And the absolute last thing the system needs right now is a retail buying panic on top of an industrial shortage. So they will deploy fear, uncertainty, and doubt to try to shake retail investors out of the market. Don't fall for it. What we're seeing right now rhymes with Gresham's law. Good money is being hoarded. Bad paper is being pushed into circulation. The people who understand the difference between physical metal and paper claims are accumulating. The people who don't are trading ETFs and futures and hoping everything works out. And when the system reprices, when the paper market loses its credibility, the gap between those two groups is going to be absolutely devastating. Let me close with a forecast. If 71 holds over the next 2 weeks, we're going higher, not in a straight line. There will be violent volatility. There will be margin hikes and forced liquidations and media narratives designed to break your conviction. But the fundamental structure is bullish. The supply is gone. The industrial demand is real, and the paper market is running out of tools. If 71 breaks and we retest the 60s or even the 50s, that will be the buying opportunity of this entire cycle. Because the physical shortage doesn't care about the paper price. Factories still need silver for solar panels. Electronics manufacturers still need it. EV battery production still requires it. And China is still not exporting. So a drop to 50 or 60 would just create even more physical demand, and the backwardation would explode even further. Either way, we're heading toward a resolution. The paper market and the physical market cannot exist at these divergent prices indefinitely. One of them has to give, and I'm betting it's the paper market. Because you can print futures contracts, but you cannot print silver bars. Watch the 71 level, watch the EFP spreads, watch the margin requirements, and most importantly, watch those vault inventories. Because when COMEX registered inventories hit zero, and I believe they're going to hit zero, the game is over. At that point, the price will be whatever the last person holding physical metal says it is. And I don't believe that price is going to be $72. This is going to be a volatile January. The rebalancing, the margin hikes, the media attacks, all of it is designed to protect the banks and shake out weak hands. But the physical reality cannot be papered over with financial engineering. The metal is gone, and no amount of clever derivatives structuring is going to change that fundamental fact. I'm not here to pump you up with hopium. I'm not here to sell you a dream. I'm here to show you the data and let you draw your own conclusions. But if you've watched this far, you already sense something is wrong. You can feel it. The numbers don't add up. The premiums are too high. The backwardation is too severe. The inventories are too low. And China just made it crystal clear they're not bailing out the Western financial system. Do your own research. Run your own numbers. Build your own plan. But don't wait for permission from some talking head on financial television who has every incentive to keep you calm and complacent. The market is screaming. The only question is whether you're listening.